Jeff Lewis is a person who bought 4 different businesses, each of them doing at least $1 million a year in sales, and he did it in less than a year.
Up until last year, we had done 4 acquisitions through 2020 and 2021.
His nearly result is freaking amazing, and I want you to learn from it. Jeff also has one of the most amazing personality I've ever met. And if we're being honest, most don't even understand those results and how they're possible, right? How he did it and became Jeff. Let's hear it.
And we have done $4.2 million in revenue over that time frame, and our profit margin is really pretty strong. So it's fun. It's crazy.
So in this episode, we break down his process to find out what made him so successful.
I own a wealth management practice. I have 2 other partners in, and I'm the financial and investment guy.
You're also going to hear about his crazy life catalyst that I believe was a crucial part of his success.
Totally was a wake-up call for me on doing something with my life that I actually cared about, because life's pretty short. She was only 24 years old when she died.
Let's break it down. Have you ever heard a sentence that says, luck is where preparation and opportunity meet? That is basically Jeff's story. There have been a few key moments that have defined his career. Let's hear about his background.
So I took about a year off and went and worked in the investor accounting division at Bank of America because I sucked at insurance after that. I just couldn't sell. I didn't enjoy doing it, so I hated it. I regrouped for about a year in the investor accounting division over at B of A, and then had the opportunity to move back into the services world and got a job at Merrill Lynch. And it was an awesome place to be. I loved Merrill Lynch. If anybody's trying to get in the financial services business that just wants to be an employee and have everything else taken care of, and you get to show up and just do your thing, Merrill Lynch is a great place to be. And I loved it there, but I knew I wasn't going to stay there.
Now look, everyone is thinking, hey, just start a business from scratch. That's why most people are not successful in business. There is a process to get there. Hear what Jeff had to say.
So we like growing both organically and inorganically through acquisitions. You know, there's pluses and minuses to both sides of that coin. We kind of feel like it's not an either or, it's an and conversation for us.
So Jeff is doing something that most entrepreneurs are not even familiar with. And that's what allows him to bring such results.
We want to make acquisitions and then grow that practice. We're looking to purchase that tax practice and then expand our other business lines into those same clients. So it's a strategic acquisition for us, not just a financial acquisition for us.
So I believe that when his sister died, it changed everything for him.
My sister died of cancer when I was working for that. I was shortly out of college. I just got my business degree from BYU, and I was at this job for like 9 months, and my sister died from cancer. And that just totally was a wake-up call for me on doing something with my life that I actually cared about, because life's pretty short. She was only 24 years old when she died. That was a reality check for me.
He was essentially doing what most people would say is crazy. And I don't think everyone or anyone could ever predict how life-changing could be for him, except for Jeff. Jeff was planning it. So after it happened, Jeff kept looking for more businesses and kind of solidified his path in this space. But his true passion was always growth by acquisition. So even that Jeff tried to grow organically his business one client at a time, he also constantly looked for acquisitions, and that helped him really get to the results he's at. And little did Jeff know that after the first acquisition, he'll find many more who want to work with him. And after that happened, it allowed him to analyze deals very fast and know what is a good deal or not. Now, if that sounds confusing, it is. To explain this, let's hear Jeff.
I guess the first thing that came to mind was I've got to just keep doing what I enjoy doing and what I know I'm good at. If you don't know what you're doing, or you're not passionate about what it is that you're in business to do, if you're not clear on what it is that gets you excited about that, I don't care what business you're going in, it's probably going to be hell.
And it's what Jeff did next that really changed the trajectory of his life. So after spending time with Jeff and him watching hours of my content and asking me questions and me trying to understand what exactly happened in here to make him unique, this is what I realized.
The first thing that came to mind was I've got to just keep doing what I enjoy doing and what I know I'm good at.
So Jeff did 4 acquisitions of mostly smaller companies.
Mostly smaller companies. So we had a small investment advisor that was retiring. Then we had a small accounting firm that we picked up.
The beauty with Jeff is he got different divisions. He got the CPA plus tax planning division. He also got business services group, right? He also got retirement division, payroll, commercial insurance for businesses, and home auto insurances. All of those are under 4 different divisions. If you notice, when he makes acquisitions, he look at any of those verticals to bring into his team and operation. It's not a random pick of a company. It's all relevant and complementary to his existing business.
So those are the 4 divisions that we have at the company. And so when we make acquisitions, we're looking for companies in any one of those verticals that we can bring on to our team and kind of assimilate into our operation.
The beauty with what Jeff is doing is they're bringing operational efficiencies and by then creating cross-selling opportunities, synergies, and creating increasing revenues because of that. It's also amazing to notice that he bought 3 retiring advisors joining them.
We've had at least 3 retiring advisors that have joined us, and then out of those 4 original purchases that we made in 2020 and 2021.
People who are baby boomers looking to retire, there's tons of them out there. Jeff realized he liked acquisitions and he wanted to do things faster, he wanted to grow faster.
My partners and I all realized that we like acquisitions, this is working well, but we got to figure out how to do it better.
Jeff understood that he can only grow as fast without acquisitions. And obviously it's good to do both. It's good to do organic growth and growth by acquisition. Jeff also got tax practice, right? So all in 2020 was Jeff's first 1 million a year in business. Think about it, he made 1 million a year in 2020, and the last 12 months they grew by acquisitions and grew by 4.2 million of revenue, and the profit margin is pretty good as well. I asked Jeff, why acquisition? And it's awesome to say that, there's obviously pluses and minuses to organic or acquisition, so you don't need to do either, like it's not this or that, you can do both. It's always a good practice to grow by acquisitions and grow organically. He says that there's a nuance in every acquisition. That's the beauty of deals. Every deal is different, and the biggest takeaway is that they need processes well defined. What they do right now is they take whatever is in the acquisition and they mold them together into their existing processes and operations. By the 3rd or 4th acquisitions, they already realize that they can't just add on those random processes, but they need to build on their own processes and do attacking acquisitions into what already established with good fundamentals.
One of the biggest takeaways that we've learned, we have to have our processes really well defined, and we're still working on that. We're like trying to fix the airplane while it's in the air right now. And what we've learned is we've got to get a lot better about having our processes down and understanding what it is we do exactly and how each team member operates within the organization and what their specific roles and responsibilities are.
Jeff is also talking about the processes that are important and the transition from the previous owner. And he's talking about not just financial integration, but also operational and cultural integration with the whole ecosystem.
When we make an acquisition, we just kind of take whatever's there and try and make it work with whatever we're doing and mold them together. The first 1 or 2 of those worked out okay, but by the 3rd or 4th acquisition, we're realizing that we just can't continue to add on all the stuff that everyone else is doing. We really do need to just have our process and the way we do things. And the acquisitions we make, we need to have an understanding before we decide that we're going to go forward on a deal, that's now just part of the criteria where we decide whether or not we're a good fit for each other.
It's interesting to hear how Jeff picked this sector, and he's talking about how the accelerator working with us really helped him with deal flow and financing and analyzing deals. I think the reason Jeff was able to be so successful is because he picked something that he really enjoyed doing. I think the most successful people have some kind of a life catalyst that changed them. Jeff definitely had this one with his sister.
Yeah, it was crazy. That was a reality check for me.
One of the biggest questions people always ask me is, how do you find businesses to buy? Hear what Jeff had to say.
Lots of different ways. Some of them were through our current network of folks that we already knew who were aging out of the business and they needed a succession plan, and we became that succession plan for them. So at least 2 of those acquisitions that we've had have been succession plan transitions for advisors that wanted to retire. And then another one was a gal that knew my business partner. She was a bookkeeper and he owns an accounting practice as well. And she came in and talked to us. She actually came to us and was like, hey, I'd like to join your company because I don't want to do this forever. I want to go be a stay-at-home mom. And so she kind of was retiring out of the business as well, but she came to find us. And all of the other acquisitions that we've had have been ones that we've gone out and looked for. So we've hooked up with a couple of the business brokers that are specifically in our space. There are business brokers in the financial and accounting space. And so we've found our other deals through there.
One of the key things is negotiating behind just money, right? Here's Jeff talking about it as well.
The negotiations on every one of them have been different because they've all had a little bit different circumstances. But the framework we've learned that we need to work within is that we've got to work on culture first. We don't even talk about price much. We just talk about what it is we're working on and decide whether or not they like that. And the direction we're headed as a company, and if they want to hitch their wagon to us. and kind of move forward in the same direction we're going. Once we've checked that box, then we'll get into the financials and we'll take a look at what their valuation ought to look like. For one of our acquisitions, we hired a third-party valuation team that was an accountant that specialized in valuations for companies. He honestly valued us much lower than the rest of the industry would value us. Or value the acquisitions, and so we actually ended up paying more than what that initial valuation was, and the bank required a separate valuation from an industry specific valuation team that put their valuation way higher than what the original valuation was. But that was good for us because we got a really low point to start with. We paid him more than that. He felt comfortable with that number. And then the bank came in and said, it's actually worth this. If we were going to lend money on it, it would be up to this amount and we'd give you 100% financing. So
people always ask me, I want to buy a business, but where do I get the money to finance the deal? Well, look what Jeff had to say about this.
Yeah, so in our space, there are lenders who will do 100% financing for us. It's crazy. And so most deal structures, like the vanilla deal structure, will be an advisor or an accountant wants to sell their practice and we make them an offer, and whatever that offer is, let's call it $1 million offer, we'll typically give the seller 70 to 80% of that offer up front, but the entire 100% will get financed by the bank minus, some closing costs and stuff. So we might come out of pocket. The one we're doing next month, we got to come out of pocket with 10 grand to close on a $700,000 acquisition.
And then this happened. Listen to this crazy acquisition structure and how it went through.
Deal structure, one of our craziest deal structures we've had, and it's more of a negotiation that we had with our purchase earlier this year in March. We were originally going to pay $1.4 million for that acquisition for the business. And as we got into the due diligence, the financial due diligence of that company, we realized that they were a dying business. They had gone from about 1.2 million in revenue down to $700,000 in revenue the year before, and they were down to like $680,000 or $640,000 the prior 12 months before we started looking at them. And by the time we were buying them, they were under $500,000 in revenue. So they were just bleeding clients like crazy. We went to the broker and said, hey, we can't buy the business as it is. We actually pulled out of the deal about 3 weeks before closing and said, we're out, we can't buy this business, it's a dying practice. And they're like, hey, time out, you knew it was a dying practice, we gave you the financials ahead of time, we're gonna sue you for not completing your end of the deal. Like, well, that's fine, you go ahead and sue us, but we're not gonna take the deal because I'd rather fight a lawsuit than buy a business that's dying and overpay for it by like 3 times. And so what we ended up offering in return was, we'll still buy the business, but we're just not going to buy it on an original all upfront cash. We'll do a down payment we offered $250,000 down, and 35% or 30% of the cash flow from the business for the next 7 years. And they came back and asked for more money up front. And so we ended up closing on $350,000 up front. We brought a whole bunch of cash to the table. We've actually got an additional like $60,000 in operational cash on the table because it takes time for the new receipts to come in for cash flow or income. We offered them eventually $350,000 and 20 basis points or just shy of 0.25% on the assets that we're still managing on a go-forward basis. So if clients leave, our future risk gets reduced by every client that leaves as well. So that was the only way we would end up buying the business. So we started with one expectation on how we were going to pay for this transaction and what they were going to sell it to us for. And by the time we actually closed, it was a dramatically different sale and financial model for us and for them. And frankly, it's the way it should have been presented to the marketplace to start with, to both us and our other competitive buyers, because there was like 10 other people they were interviewing to purchase this practice. It was with a broker, and it never should have been listed as an all-cash sale. It should have been listed in some type of ongoing transaction like this. So yeah, long story short, it was a very stressful closing. It was was by no means a smooth transaction. There was a lot of pain and heartache along the way, and we finally got to a deal that worked for us. They're not really happy about it, but it's the only option they really have. And unfortunately, this is where brokers really cause problems, or they can be heroes to both sides of the transaction. And that is that the broker should have done a better job helping the seller understand what kind of business they had and what their real prospects should be on how they sell that business. And they were just trying to get the biggest bang for their buck, which I totally understand. That's what they get paid better for. That's what the client gets paid better for. And that's what the client ultimately wants. But honestly, in the marketplace, if the transaction doesn't work, it doesn't work for anyone. If it doesn't work for the buyer, I mean, it really doesn't work for anyone, because the deal blows up and nobody's happy. My advice there is to anyone looking at these transactions, if they're getting to the point in the deal where it starts to not make financial sense because of what you're uncovering, don't be afraid to back out of the deal and tell them exactly what you want. And I wish we would have told them sooner exactly what it was we were looking for and exactly what we would do, because it would have saved us all a lot more pain, and we probably wouldn't have ended up buying the practice if we would have been too upfront with that information on what it is we really wanted. But I'm glad that by the time we finally got to the closing table, we were willing and had the guts enough to tell them that we were just going to walk away, or you can do it like this and we'll still buy it.
Another important thing to take care of is the process post-deal. So after you buy the business, what do you do then?
We're not typically buying the entity, we're buying the book of business and the goodwill and the future cash flow of a business. There's typically a 3 to 4 month window where we're meeting with every single client to have them sign new paperwork with our company and then transfer the assets from wherever they had them, whether that was at Edward Jones or Morgan Stanley or Fidelity or whoever else, over to TD Ameritrade, where we do most of our investments. And so that process takes quite a bit of time, and usually in that process we get the opportunity to tell the story of what it is we're doing and why they're selling the business to us and what our plan is to continue serving them moving forward. And in most cases in our world, the clients are pumped about it because their advisors are older and they're like, I've been wondering how you're going to take care of me for the rest of my life when you're going to retire someday. So that's the typical process for us post-acquisition when we're buying a business on the investment side of the world. When it's a tax practice, those are the other types of businesses we've purchased so far. Those typically we have their team work with us and they become Epic employees. So they become employees of our company. We transition the revenue of that company for all the credit cards or deposits they have for checks or whatever from tax returns or whatnot. We just convert those deposits to our bank account rather than the old bank account that they were going to before. And that team typically stays on. And we do follow a similar process where we meet with every client. For the tax side of the practice, we typically just meet with them at the next tax season. So we'll send out a letter, we make some phone calls to the bigger clients, we have them come in and do some mid-year tax planning, but then we really meet with most everybody just during tax season. And so it's a very, very hands-on transition process for us.
I found that the most successful people always have goals, right? Here, Jeff, either about selling the business or going public. Look what he had to say.
Really what we want to do is we want to take this company public. We want to go build out enough of our operational processes and marketing processes that we can come into another tax practice or financial practice and say, you should join us. Here's why. We're going to help you grow. We're going to help ease your time in your business by adding new capacity from other team members or technology. And then we're going to help you acquire other smaller businesses as well that can add to your revenue. And eventually we're all going to conglomerate this big cash machine together and either go public or sell it to a private equity firm.